Okay, everybody, let's kick this off. I hope you can hear me well. I hope you can also see the screen in front of you. The topic today that we are going to discuss is Bollinger strategies in currency trading. Okay, for those of you that are new to currency trading, this will be specifically applicable to your trading as you become or you are already a Tickmill member and a trader. Bollingers are very powerful formations in the market, and we are basically going to discuss a specific Bollinger strategy that we use in our trading, and we hope this can add some value to your trading as you go on. Okay? The agenda for today is to discuss price action versus mean reversion. This is the two main types of markets that you will face. It depends where you are based in the world and which sessions you trade as a trader, as an FX trader. There are typically four main market sessions, and they begin with Asia and they end with the US. Okay? And depending on which type of session you're trading, you're going to be facing what we call a trending market or a mean reverting market. And then we will go over a specific Bollinger Band-based strategy that you can use. It is very simple to deploy. It's not too heavy on indicators or anything like that. All right. And then we will, of course, discuss recommended risk management, how you can set your stop loss and your take profit levels so that you maximize the efficiency of this Bollinger-based strategy. And then, as always, I like to end on discussing some currency trading dangers that are specific to the currency trading market. You know, the market is very big. It has almost $4 to $5 trillion in liquidity that is turned over every day, okay, in this asset class. And with it, there's a lot of market participants, a lot of research that goes into it, lots of financial modeling and all of those things. But with it, there's also a lot of dangers that come in the market, and we think it's important that you realize these so that you can navigate more profitably. And then last but not least, of course, we will have a questions and answers session. If there's anything that I've missed or anything that is unclear, I'll be more than happy to answer your questions here via text or via voice. And at the end, you can email your Tickmill support, of course, if I have still not answered all your questions. All right? So a few things to note here. What differentiates a good broker versus a bad broker? And I think what you will see here with Tickmill is that you have very low spreads. You have access to direct ECN accounts with spreads starting from zero spread, so that impacts cost of entry in a favorable way. There's no requotes. You know, requoting is a common problem in the FX market. For those of you that are more intermediate and advanced, you will come to see this. All types of strategies are accommodated for by the platform. You know, whether you are a scalp trader or arbitrage or news or duration. Today, the strategies that we're going to discuss are for scalpers and also for traders that are taking slightly longer term positions. There is no negative slippage or very little negative slippage. In terms of the security of your funds, they are, of course, lying in segregated funds and accounts at top tier banks so that you can rest that your funds are safe. And of course, there is no hidden conditions and charges. Please bear with me. I am required, before I proceed with this webinar, to read you this legal disclaimer. The contents of this material are provided by a third party, not Tickmill, and are for informational purposes only and do not constitute investment advice. Tickmill and the speaker assume no responsibility for any potential errors, inaccuracies, or omission in this material. Nothing in this communication contains or should be considered as containing an investment advice or an investment recommendation or a solicitation for the purpose of purchase or sale of any financial instrument. Any views or opinions presented within this material are solely those of the author and do not necessarily represent those of Tickmill unless otherwise specifically stated. Currency trading may not be suitable for all investors as it carries a high degree of risk to your capital. Trading such products is risky and you may lose all of your investment. Past performance is not indicative of future results. rates, expiry times, market volatility, and platform errors could result in losing trades. Before deciding to invest in currencies, you should carefully consider your investment objectives, level of experience, and risk appetite. You should be aware of all the risks associated with foreign exchange and currency trading and seek advice from an independent financial advisor if you have any doubts. Okay, now with this out of the way, we can get into the main webinar. So as I mentioned earlier, depending on what type of trader you are, whether it is very early in the curve and you've just entered trading, or whether you are a very experienced trader, either way, you're going to be typically experiencing two types of markets. The first is the trending market, okay, the market that breaks out because of news or some fundamental or sometimes a technical event, and it causes a trend in the market. Right? So the euro versus the US dollar may rise for weeks consecutively or hours or days, and it may drop. And these trends are very powerful. And generally speaking, if you are able to identify a trend, you can bet in the direction, or you can take a long or short position in the direction of the trend and exit safely, especially if it's driven by news. However, you will come to experience that trend trading can be tricky because you don't know when the trend may end. You don't know where you are in the cycle of each trend, and therefore you need to be, it's a little bit more difficult than to trade what we call mean reverting markets, mean reversion or ranging markets, where generally speaking the market has no real trajectory. It's moving between a range, okay? And normally this range is between your resistance and support levels, for those of you that have heard of those. And specifically for this webinar, normally the market is well contained within a Bollinger Band range, right? You can exploit this. You can exploit this range-bound trading very well. And the strategy that we're teaching you today, this advanced Bollinger Band strategy, doesn't really use indicators. You can, of course, use indicators to optimize it, but it doesn't require indicators to make money with it. That's the beauty. It's purely chart-based. And we are going to basically be discussing this today. Now, before I discuss the strategy in depth, I think it's important for those of you that are new, just for me to describe to you what Bollinger Bands are, okay? What you are seeing here is a typical MT4 chart straight out of your Tickmill MT4 platform of the price. And what you're seeing here is, this is an 8-hourly chart, and you're seeing that the price is generally headed up, creating higher highs, okay? It's moving up in a classic wave pattern up with mini retracements, and it's headed up, and then it's starting to peter out. It's losing some steam, okay? And what you'll notice is that the Bollinger Bands generally tend to contain the price. Each time the price hits the north of the Bollinger Band, it comes back down and it finds some supply. Normally it comes down all the way until the moving average, which is the middle band. Okay, you see three bands here. You see the middle line, you see the lower line, and you see the upper line. Okay, the upper Bollinger Band generally tends to push the price down. The middle Bollinger Band tends to repel the price up, and the lower Bollinger Band tends to contain it. It tends to catch the price if it tries to fall. Like you see here, it tries to fall, but then it eventually resumed its upward trajectory. Now, this is the fundamental way of explaining it. The mathematical, for those of you that are more mathematically inclined, actually what the Bollinger Bands are is they are standard deviation calculations, right? So effectively what the Bollinger Band is saying is, what is the deviation of the price, okay, the movement of the price around the mean or the average, which is the moving average. That's the middle band, okay? So if you have Bollinger Bands that are very far apart from each other, then it means there's a lot of volatility in the market. If you have bands that are very tightly together, like you see here, that means there is consensus in the market, generally speaking, and that the price is probably headed in a either flat, either up or down. Okay. Now, the silly thing to do is to just simply open a short order when the price hits the upper band and open a long position when the price hits the lower band. That doesn't always work, right? So what we're going to look at today is actually 4 specific formations of Bollinger Bands, okay? Specific formations of how Bollinger Bands present themselves with respect to the slope, okay? So the trajectory of the bands and the price inside it. And these are certain formations that you will find every day in the market, right? Depending on what time you're trading. And we'll go over 4 key formations. The first one is the channel surfer. and basically is a price action strategy. So here you're actually betting, or you're taking a trade, you're investing in the direction of the trend. All right, this is a price action strategy, a trend trading strategy. The waterfall is also a trend trading strategy. Again, you're betting here on a fundamental trend. So you're betting here on one pair rising and rising and rising, or falling and falling and falling. All right, and we'll discuss support and resistance points with that when we get there. Then we look at the hummingbird, which is it's actually it's a blend. It's a blend between trend trading and mean reversion. But generally speaking, when you see this formation in the market, it's a sell signal, right? It's a short or a sell signal. It means the pair is experiencing some exhaustion. It's risen a lot during the day. And this is an interesting one for those of you that trade later in your trading days. And then last but not least, we will discuss the breakout, which is a very classic Bollinger-based formation where normally news drives it. It drives the price to explode up or down, and it creates a breakout formation, and those can be very profitable if traded correctly. Okay, so we are going to discuss 4 formations, Bollinger Band formations, which you can embed in your minds. You can practice them, of course, with virtual money, and then eventually when you start to win, you can go live. Okay, so the first one is basically the channel surfer. Okay, and what this is the price surfs, or it scrapes the upper Bollinger Band for a period of time before, and it creates higher highs before coming down to find some supply. Okay, it actually scrapes the upper Bollinger Band, then it comes back down to create a high which is lower than the previous low, and then you use this touch of the moving average to open your long position with the view that you can close your position after the price goes on to create another high, or when it goes on to create another wave up. All right, so this channel surfing formation happens in 2 directions. It's the northern or the upward channel surf, or the lower channel surfer. Okay, that's the theory, and this is kind of how it looks. All right, this is a live chart, what you see here, and what you're typically looking for is a tight upward or downward trending Bollinger channel, right? So in this case, you'll notice this is an upward trending Bollinger channel, and it's relatively tight. It's not like there's a huge distance between the Bollinger Bands, because that indicates that there's big indecision in the market. What you're here looking for is relatively tight Bollinger Bands, about 5 to 10 pips. Okay, and for those of you that don't know what pips are, there are a lot of pip calculators on the web. You can Google it. But basically, this is a 5 to 10 percentage points of the currency, and if the chart's tight and it's trending up, this means that there is an upward trend. And what you're trying to do here is you're not trying to take a long position or open a long position or buy lots somewhere here or here. You could do that, but a lower risk way of doing this is wait for the corrective wave, right? So this up move here is known as an impulse wave. This is a corrective wave, second impulse wave, corrective wave, and you're basically looking to get in when the price hits this middle line, which is the moving average, right? What you'll notice is that when the Bollinger Bands are sloping, when they are trending up, or when they are trending downwards, all right, this middle band here, okay, becomes supercharged. Think of it like it's a magnet, and it reverses its polarity, so it starts to push price away from it. I'll say this again. When these bands here are not flat, but when they are trending up or when they're trending down, this middle band, or the moving average, becomes supercharged in that it starts to repel price. It pushes price up. Okay, it's like a trampoline. And this is the effect that you want to use to your advantage, and you would effectively open a long position here. Okay, and we will discuss stop loss management and profit levels and trailing losses and tailing take profit levels in a bit. But in short, what I can tell you is, because this is a trend trading strategy, and if assuming you're not getting in late in the trend, you don't need to have a wide stop loss. You don't need to set your stop loss 20, 30, 40 pips. Typically, you would set your stop loss for this. Where do you think? At the nearest resistance level, which is the lower Bollinger Band. Because if the price does continue south, breaks that, there is a strong possibility that it will result in a breakout, and it will continue south. And you don't want to be chasing that trade. You never want a martingale. You know, that's a recipe for destruction. You want to limit your losses because a lot of these formations happen all the time in the market. All right. We'll discuss calibration more in depth, but what I will say is a lot of you are probably asking, what is the time frame for your charts, right? What are you going to use in your MT4? And typically, we would suggest 30 minutes or 1 hour charts to identify these, right? 4-hour charts is a bit too long unless you're taking, positions per day or longer term positions. But generally speaking, 30-minute to hourly charts are fine for this. That was the channel surfer. Now let's discuss the waterfall. All right. The waterfall, generally speaking, occurs when you get 4 or more candles of the same color in a row. Okay. So what I mean by same color, assuming blue is up and red is down, this picture here is effectively showing you well-behaved candles every hour moving up or down. All right, or every half an hour or every 15 minutes moving up. And these candles can't just be any types of candles. Okay, for those of you that are new to candlestick theory, please spend some time on getting up to speed with it. It is absolutely important and vital. You need it to trade and survive in the FX markets. But generally speaking, candles with small wicks, okay, small wicks is what you're looking for, because that's telling you, okay, you know what, the market is very well decided that the price is headed up. Okay, it's a classic trend indicator. If, however, you're getting small candles with very large wicks, right, or almost similar to dojis, or you're getting very large candle bodies and large wicks, right? So you're getting one candle body that's very large, one that's very small, one that's very large, and one that's tiny with a large wick. That's basically the market telling you that, yes, there is a trend in play, but you don't know when it's going to end. And at that point, you want to stay out of the market. By comparison, the waterfall effectively looks at a very stable trend up. What I'm talking about is uniform candle bodies, uniform size, anywhere from 5 to 10 pips in size, and similar wicks, right? You don't want crazy sized wicks, because a large wick normally indicates indecision. The market has had some degree of change in mind. When you find these waterfalls, and there are some occurring as we speak right now, and they occurred yesterday as well, so it's not difficult to find them, it is likely that the price will continue to trend in that direction for anywhere from 15 minutes to 2 hours, right? And I know that's a large, why again you need to set your stop losses relatively tight at the nearest resistance, or sorry, support level if you're taking a long position. And also, you're not going to go in for big trades here, big pips. Generally speaking, you're going to trade these formations with a 2-to-1 risk-reward ratio, right? So the amount of pips that you want to capture should be twice the amount you would potentially lose, and that's the way to play these formations. Okay, so the waterfall, you know, what initiates a waterfall? Why would a waterfall occur in the market? And the reason behind why waterfalls generally occur is either when there's a big buyer. Okay, this could be a institutional player. It could be a proprietary investment player like a hedge fund. It could be a sovereign. It could be a country buying currency reserves. It could be a vast array of factors, but most importantly and most probably, it's just news or big headlines. And normally, when you get unforeseen news, you get a breakout, and that breakout then turns into a waterfall which can last for a few hours. And it's that trend up that you want to play. And this is a fantastic example. This is US dollar Canadian, okay? And you're seeing that this is a classic example of a decent, well-behaved waterfall, right? This here, slightly more risky waterfall because you have a doji in there, you have some hammer type of candles, but again, it would have been a winner, right? So it's relatively robust, these formations, okay? But take a look at this. This here is 4 candles, right? Let's say 4 hours. And what I'm seeing here is one crazy candle, which is almost a doji. It's a very large wick, small candle body. Then here I'm seeing actually a hammer, which is a small candle body and a wick below it. And here I'm seeing a full candle with no wick. And then here I'm seeing a partial doji, right? Immediately, this is telling me this is not a trend that I want to be part of, right? I do not want to open a long position here. It could be because there's resistance here that I haven't plotted on this chart, or it just could be that this trend up wasn't driven by any news or anything significant. Now, if I opened a long position here because I got excited, I would have lost. right? As you can see, eventually, at some point, if I would have set my stop loss here, it may or may not have been triggered, but eventually it would have been triggered. So develop a keen eye for how to trade these waterfalls. They occur all the time, and use news to propel or create these events in the market, and then you can identify them easier. All right? Let's discuss the breakout now. I briefly went over it here in the waterfall. Generally speaking, the cycle of price action in the market is as follows. The market is quiet, it is ranging, it is range bound. When there's no news, when there's no new information, no new big buyers or players, the market goes into a range mode. It starts to just range up and down, up and down. When news comes in, the market will break out, right? It will actually break out of its range because it has to reprice currency. It has to reprice the asset based on the new information. After the breakout, when all that explosion is done, there is remnant strength or remnant short selling that occurs if the news was bad, and that causes these waterfalls. But eventually waterfalls also peter out, they also lose steam, and they become weaker, and then they start to drop towards the moving average. Notice here, this waterfall continued up. It kept on hugging the upper Bollinger Band, right? It found no need to even come down and find supply at the moving average. It continued up and up and up, and then it actually started to lose steam, and look what it turned into. It actually turned into a channel surfer, right? So all of these formations are interconnected, and that's the beauty with this. You can play all of them when you identify them. So let's discuss that breakout. So what causes a breakout? Extreme events or major news events, right? Like the non-farm payrolls is the most popular or the classic one. That causes a breakout, for example. And a breakout typically looks like this, where the Bollinger Bands, and we'll look at one in a more clear way shortly, but this is kind of how it looks in theory. The candle pierces the lower Bollinger, and the lower Bollinger starts to diverge with respect to the upper Bollinger. They open up. It's like an alligator's mouth. It looks in different directions, right? And this is known as Bollinger divergence, and that confirms a breakout. News-driven breakouts are the ones that we personally treat, that we believe are the most powerful ones. And price, normally, if the breakout is real, and I'll tell you what I mean by that, if the breakout is real, it can continue in that direction for 15 minutes to 2 hours, sometimes even a few hours, if it's a major news that was unexpected. For example, if non-farm payrolls are predicted at 200,000 jobs and they come in at 300,000, which has happened, that's probably going to make the dollar rise up sharply, and the euro-US dollar will go into a tailspin, and that can last hours, right? That can really last hours, and that's an amazing profit making opportunity. The problem is that the market will sometimes supply you with head fakes, or what we call fake outs, which are not breakouts, but they look like breakouts, but they immediately revert back to the mean. All right, this is, for example, an example of a fake out where boom, the price moved up, boom, it moved up again, but immediately it was constrained back by the Bollinger. Right, there was no news driving this, there was no real buyer, it was just some rumors possibly, and immediately shot back down. Right, and then it went into this kind of range-bound, controlled volatility environment, which is something FX traders should stay away from, right? But this here, a few hours later, this is an hourly chart for the euro. Sorry, let me just check out. This is the euro Canadian currency cross, and what you're seeing here is a classic hourglass formation, which characterizes or depicts a breakout, right? And what you're seeing here is, if you follow my pencil, the Bollinger Bands are thick, okay? And they're starting to converge. They're starting to look at each other. They're starting to get tighter. This means that some consolidation is happening. Some event is about to happen when you get the tightness in bands. And boom, you have the first breakout candle, the second one, and it's established, right? It turns into a waterfall. And look at the bands. The lower band is facing south. The upper band is facing north. So you have a classic convergence followed by a divergence, and this breakout was real. Now the thing is, if this is driven by news, you want to trade it. But if you don't know what's driving a breakout, we would suggest you avoid trading it, because it could just crash and burn 30 minutes later, and you could your stops could be triggered. The interesting thing about a breakout is, and similar to a waterfall, is that it's a low risk strategy relatively. And the reason I say this is if a breakout is real, it's not going to find the moving average. Like the channel surfer went down to find supply at the moving average, if you recall, right? Because it just didn't have enough steam, so it would continuously come back to moving average. You get some, some bulls coming in, driving the price up, but then they would take profit. Again, bears would take over, and this kind of repeats itself. A breakout is very powerful if it's a real one, and you're probably not going to see it coming back to the moving average for a while. In that case, you can set your stop loss or trailing stop loss, close to the moving average, so that it tracks the moving average as you go up, and you lock in more and more profit, and then take your profit at whatever level you like. Personally, we like to keep the take profit levels tight, maybe 2 to 1 or 3 to 1 on breakouts. But generally speaking, these are powerful ones to play, especially when they're driven by news. Okay, so let's take a look at the hummingbird. This is the fourth formation, all right? And this is a unique formation. It looks kind of like a bird, and in this case, the Twitter bird. And if you'll notice here, it has a very distinct body. It has a body, it has a head, it has a beak as well. And this is on an hourly chart. And you don't want to find these in the morning, right? When I say morning, I'm talking about the European and the London morning around 8 a.m. to 9 a.m. GMT. Because if you're seeing one of these, this could just be a mini correction waiting to happen, and then the rest of the day you get the price moving up another leg, right? You don't want to play these during the day. This is not a bearish signal during the main market hours. But if you see that the price has risen, let's say a currency has changed more than 1% during the day or 2%, which is a very significant move, normally that would be driven by news. So let's say the currency has risen a lot, 100, 150 pips. You're going to start to see exhaustion patterns set in. And exhaustion, for example, please observe here, this is a classic waterfall up, right? It's a classic breakout driven by European news. Notice here. It's a classic breakout, and then as the day goes by, you see the first doji, and you start to see some exhaustion setting in with red candles. That basically means that the trend may be coming to an end. All right. For those of you that use Fibonacci retracement analysis, which we'll have a separate webinar shortly on how to trade using Fibonacci, you could draw your Fib retracement pattern here to see until where the price could drop until, right? But the key thing is when you see a hummingbird later in the day, so I'm saying somewhere between 5 p.m., 6 p.m. GMT, it's probably going to retrace a little bit and give back some of its gains, which is a bearish signal, which means you could open a short position, okay? And you would use the moving average. Again, I haven't drawn out the moving average, but let's say the moving average tracked the price. You would basically put your stop loss at the moving average. Effectively, it's what we would call a reverse channel surfer, right? So if this is an upward channel surfer, the beak of the bird would be a southern channel surfer, right? We assume that the Bollinger Bands would eventually turn south. All right? So just to recap, we've gone over, that's the strategy, by the way, that's it. And it's effectively just 4 formations, and the market manifests itself normally in about 7 or 8 different ways. We've gone 4 key patterns, and these are recurring, okay? They don't only occur once a week or once a month. They occur almost every day. You just need to look for them. And now we're going to discuss, how do you manage your risk? So the general guideline is that we suggest you follow the Kelly percentage or the Kelly risk management formula or criterion. And this is more complicated than it really is. It looks more complicated. Effectively, what it is asking you to do is that the amount of percentage of your total account equity that you are willing to stake on any given one trade should be a combination or should be based on your win rate, your historical win rate as a trader. All right, maybe that's 50% or 55 or 60. And then it should be a function of 1 minus your win rate divided by your profit factor. And the profit factor basically judges historically what your total profits have been in FX divided by your total losses, the absolute losses. And hopefully that figure is greater than 1. Now the thing is, it's not all about the win rate. In currency trading, there are some really fantastic traders that are generating 0.5% return on their total equity every day, or 1%, which is fantastic returns, by the way. And they are doing this with a win rate of just 40%. right? Or 35%. So they're winning 1 in 3 trades, but their profit factor is through the roof. What this means is when they win really big. They have risk-reward ratios of 5 to 1. And when they lose, they may be losing more often, but they manage to curtail the dollar value of their losses very well. So overall, their capital is still growing, right? Despite their win rate being under 50%. That's perfectly normal. That happens in FX trading. Now, for those of you that are a bit more advanced, you can use the Kelly formula, but what we would say is that don't allow this to exceed more than 5% of your capital for any trade. Actually, to be very risk averse, we would say 1 to 2% maximum per position, right? But we're saying 5% because if you have a small real money account and you're trading with high levels of leverage, maybe you're participating in some of these more quote unquote exciting accounts which offer you 400 to 1 leverage, 100 to 1. It's not something that we condone or we urge, but if you have really small dollar accounts like $100 to $300, then obviously this 5% thing may be something you may need to consider. But if you are sitting on a large account, $10, $20, $30,000, then we would suggest that this figure should be less than 5% easily and closer to 1%, just to be safe. All right, so now let's discuss calibration, and I'll go over stop losses and take profits there as well. On the charts, basically, as I said, you're looking for 30-minute charts, 15 minutes in some instances, but generally 30-minute and 1-hour charts, right? That's the type of time frames you want to identify the breakouts, the channel surfer, the waterfall, the hummingbirds. Please add candlesticks with Bollinger bands, okay? If you don't already have them on your charts, it's vital that you add them. Now, for those of you that are a bit more advanced, you may ask, can you use Heikin-Ashi, which is a new way of, not a new way, sorry, it's a different way of calculating candlesticks, open, low, high, close prices. Both are Japanese forms of indicators in the market, and you can use Heikin-Ashi for all the formations we have shown you. We won't discuss that in this webinar, but generally, at the very least, you need candlesticks. And the Bollinger Bands, you can attach them as they come. So 20 periods, 2 standard deviations is fine. For lower risk and higher quality trades, we would suggest 25 periods and 2 standard deviations. And for higher risk and lower quality trades, we would suggest, and more trades, by the way, we would suggest 14 periods and 2 standard deviations. Very important, please don't trade correlated. What that means is, for example, the Euro-US dollar and the US dollar-Swiss franc are inversely correlated pairs. When one rises, the other falls. So if you are going long Euro-US dollar, you're effectively long Euro and short US dollar, right? But at the same time, if you short US dollar Swiss franc, you're kind of basically short the US dollar twice. So you're doubling up your net exposure on the dollar. Please be careful when you're trading correlated pairs. Trade one pair at a time until you become really good. Now on stop losses. So 2 things you can do here. Firstly, when you're starting off with these strategies, use virtual money. You want to test them out first. When your trade process is refined enough that you're making virtual, then you can go live, and then you can effectively, the stops that we would suggest are somewhere in the 10 to 20 pip range, and the take profits should be sort of in the 20 to 30 pip range. Although it says 5 to 15 here, this is an error. It should be kind of in the, it should be at least 2 times your stop losses, so that your risk reward is 2 to 1 at the very least. All right. Now, this will of course totally depend on your own risk appetite, right? So if you're trading a news-driven breakout, you may have a tight stop of 15 pips, and you may also set it to trailing, which means as the price moves up, your stop loss moves up as well, and it tracks the moving average, which means in the event of a sudden drop and your stop is triggered, you've still locked in some quote-unquote risk-free profit. So trailing stop losses are really good when you are wanting to take in some excess profits or excess pips, right? And that works in a trend, in a powerful trend like a breakout, or in a waterfall as well. It won't work that well in a channel surfer because these are weak trends, and it won't work well in a hummingbird because you don't know when it might just find the previous resistance, which has now become the support, and then continue its leg up, which you can triangulate with the Fibonacci retracement. All right. If what I said just sounded a bit too technical, I do apologize, but this is more aimed at those who are a bit more advanced along their trading curve. All right. So this is effectively your calibration. You're going to ask about indicators, and with regards to indicators, you can certainly use relative strength index. You can use stochastics. We don't use the moving average, convergence, divergence indicator, MACD, so much. Again, if it's something that's worked for you, you can incorporate all of those into these Bollinger chart formations to give you better entries. But we would not suggest building a strategy just based on indicators. It makes no sense. It doesn't allow you to really comprehend what's happening in the market, right? It's very surprising to find a trader who's built their entire trading career and strategy just when certain indicators meet certain parameters and values, they fire long and short. That's not a very sustainable long-term strategy. So this is the calibration, and quickly we'll go over the currency trading dangers. Okay, so there are expert advisors. This market is very lucrative, a lot of money in this market, so a lot of scam-like products can enter, and you have to be very careful. Unfortunately, a big portion of these expert advisors are scams. There is no other way to put it. They are generally underpriced. They seem too good to be true. They will show you a performance link over years, which is on demo money, which may be fudged, leading you to believe that it's going to grow your capital. Just be very careful. You may find one that works for you, but we have not. So just try and be careful. On deposits, so statistically speaking, about 10%, somewhere between 5 and 10% of all traders make money over the long run in currency trading, right? So it's a low fraction, but it is possible to make good money in currency trading if you apply a good strategy in money management. Sometimes human emotions get the better of you, and this happens to the masses, believe it or not, and you may lose or experience a very heavy drawdown in investing in currencies, and you may even blow an account. So what we would suggest is we would consider it's part of your education. It's the cost of your education in this market, because as long as you're learning from those losses, you're going to become a better trader, which also means that you don't start with a $50,000 account or a $10,000 account, right? Because you don't know what's going on. If you're new to this market, there is so much complexity and variables that are firing off all the time, and you really need to take some time to understand that before you start to bet big. And in the event that you experience a loss or an account wipeout, we would ask you to not quit. I mean, that's you could, of course, if you hate trading, but if you still enjoy trading, you enjoy the mechanics, the research, then it is for you. It's just that you got to let the emotions get better of you, which means you just need to try and control and learn from your mistakes better when you trade the next time, right? And then, as a corollary to what I said about the EAs, or these algorithms, and the ones that auto trade your account into ruin most of the time, we would also ask you to be very careful with signal services. Signal services, especially if they're purely robotic, can sometimes be subject to macroeconomic risk, and they can't take into account news, and they can give you some very dangerous signals. Just trade with demo money for if you're excited about signal service, just trade it with a month with demo money and see how it does, and then you can, if it's working for you, you can go live. The classic account is the one that is recommended by Tickmill. You can see here that there are variable spreads anywhere from 1.2 to 1.4 pips. There's 0% commissions per trade, and the minimum deposit is relatively small as well. And obviously, as we discussed, very high levels of leverage can be offered. And you can also enter trades with micro lots, which is important. The execution speed is almost instantaneous. That was the webinar. I really appreciate you all coming here and attending during your trading day. I will now take questions. Okay, please go ahead. You can use your text to send me questions. Okay, I see a question from Christoph Genau. The waterfall strategy is also depending from the Bollinger Bands. Very good question. So actually, no, it's not. That's a very good catch. So actually, the only thing that the Bollinger Band will give you here, the indication, is that if the candles are regularly hugging the upper Bollinger or they're closing outside the upper Bollinger, that's a good sign, right? As long as you're not seeing this shooting star effect, which is a sign that the waterfall is ending, and look, it eventually did end. It's as long as they're hugging the upper Bollinger Band, that means that the waterfall will continue. So that's a good indication. I see a question from Rumen Petrov. Can we get a PDF of the seminar? Yes, you can get in touch with your account manager at Tickmill, and they will take it from there for you. Okay, I see a question from Vile Sarpola. Okay, Vile, the setup, there are 3 types for the Bollinger Band lines. He's asking, he's missed the Bollinger Band setup. Basically, if you add a Bollinger Band, it will normally come with 20 and 2, which is 20 periods look back and 2 periods standard deviation. That one's absolutely fine, all right? If you want to reduce your risk and you want to increase the quality of your trades, make the moving averages more powerful as launch pads for Channel Surfer or for Waterfall, whatever, then we would suggest you moving to 25 periods, all right, and 2 standard deviations. And if you want more trades but lower accuracy, then 14 periods and 2 standard deviations. All right, I see a question from Muhammad Lutfi Aula. Is it a daily Bollinger Band or weekly or 8 hours? Okay, very good question. So this depends on your investment horizon. So if you are, for example, I trade these on 1 hour charts with the view that my take profit will be hit hopefully within the next hour or 2 hours. So always match your investment horizon with your chart time frame. So you can trade these patterns on a daily charts as well, but then your positions will be open much more longer. And of course, you will need to calibrate your stop losses much more wider and your take profit levels, because if you leave positions over the days, then of course they become subject to macroeconomic and news risk, which means that you need to have a larger variance appetite or the ability to sustain a larger drawdown, but also therefore hope for a much larger pip spread when you win. So the answer again to your question is basically depends if you're trading for weekly positions or hourly positions. This strategy works for all time frames, but it does not work for 5-minute and 1-minute charts for very short-term positions. The laws of Bollinger's tend to break down. They become very shaky when you go on the tick charts and the minutely charts. I see a question from Doan Edward. Which type of broker is the best, ECN, STP, or MM? Doman, when you're starting off, ECN is fine. It purely depends. I mean, again, with respect to how this works in Tickmill, I would suggest this question is probably best answered with your account manager, who will give you the benefits and the drawbacks of each type. See a question from Hilman Pradana. Do you use another indicator to predict a trend, such as moving average? Okay, so Hilman, for me, Bollinger Bands, by the way, the Bollinger Bands contain the moving average, right? That's often sometimes traders forget, the new traders. It actually is a moving average. Now, you can use a second confirmation, which is known as moving average crossover, where you plot a slower moving average, let's say 50 periods, and you plot a faster moving average, let's say 10 periods or 15 periods. When the slow moving average, the one for 50 periods, is crossed from below by the faster moving average, let's say the 10 or 15 period one, that is a bullish indicator that market tide may turn, right? So if you are, let's say, looking at a Channel Surfer, and you're kind of worried that, okay, have I missed the trend? I'm somewhere here, it's already done 2 waves. What you could do is wait for confirmation, plot a slower moving average and a faster one, and if the faster one crosses the slower one from below, it could mean that there's another wave coming, right? You could also learn Elliott wave theory, which is a very overhyped and overcomplicated theory, and it is difficult to implement if you don't tie it in with Bollinger, right? Because a channel surfer is basically the 1, 2, 3, or 4, 5 impulse leg of the Elliott wave pattern. We've just simplified it and added Bollingers, so it kind of makes sense to most traders. But generally speaking, you can use Elliott waves, you can use moving average crossovers. You could use MACD as well. For MACD is not entirely useless on hourly and 4-hour charts. It does have some validity to predict trends. I see a question from Rumen Petrov. How do you set take profit for each strategy again? Okay, good question, Rumen. So you know how to set the stop losses. I went over that. Typically, you always set the stop loss at the nearest point of resistance. So if you enter at the moving average to go long, your loss would be at the lower Bollinger Band. For the take profit level, it depends on your risk appetite. I personally would set it 5 pips above the previous high. So if this was a previous high, set it 5 pips above that, and I would get the moving average with the view to take probably 10 to 15 pips or 20 pips, and my stop loss would be 10 pips, right? So I'm a risk reward of 2. Wherever you have set your stop loss, let's say that is 10 pips below your current long entry position or your 20 pips, make sure that your take profit is that amount at least, so that your risk reward is calibrated. It's actually worth you risking those 10 or 20 pips so that you earn 20 to 40 pips, if that makes sense. So let your take profit level be determined partially by your stop loss, and of course use natural resistance points. So if you have R1 here somewhere, or let's say here was R1, okay, which is your first resistance points. For those of you that don't know resistance, we'll cover that in another webinar. But here, let's say this was your resistance 1. The price broke that firmly, so that resistance then became support, as you know, and the price then went on to tag higher highs. I would basically set my take profit at the next pivot point, which could be here, or all the way up at R2. That's the way I would do it. That's another way to do it, right? But again, this is something that you need to calibrate based on how you fare with these strategies. Okay, I see a question from Muhammad Lufti Aula. How your standard deviation is in use, 1 or 2? In MetaTrader, use 2 to normal, but in statistics, it's 1 is normal distribution. Very good question. You're absolutely right. Please use 2. Okay, 1 is too tight. Basically, you're going to get moving average here, and then the band is going to be right next to it. So the price will continuously break that, and it's almost nonsensical to use 1. You'll see what I mean. You just won't be able to see these formations that well. Equally, if you go to 30 or 40, again, it will just look like a flat band relatively. So you need to find that perfect fit or the ideal calibration. And in our experience, 2 standard deviations or 2.5 standard deviations is the number. I've seen some traders use 3.5, but if you start to move towards 1 and 0.9, it just creates noise. Any more questions, anybody? Sure, thank you all for your questions. Any other questions? Rumen, these are visual chart formations on different time frames. So in answer to your question, no. Backtesting a channel surfer would take quite a bit of horsepower because modeling the Bollinger channels, the trajectories, the entry points, that's not something that we have backtested, but it's certainly something that you can forward test with virtual A to get comfortable with it. I see a question from Vile Sarpola. Leverage, what is the best leverage for beginners? Great question, Vile. So, I personally get a bit scared when I see leverage levels of 400 to 1, 500 to 1 being used by beginners, because it's everyone wants to take a $500 account and make it 10,000. We would suggest for beginners a leverage of 10 to 1, somewhere between 5 to 1 and 10 to 1, just until you get the hang of things. I started with 5 to 1 and 10 to 1, and then I moved eventually to 40 to 1, but that was kind of the maximum I ever went. Personally, I've never used 100 to 1 or 200 to 1 leverage level. Okay, Michelle, I see a question from Michelle then. I entered the webinar late. I got the time mixed up. Do you have a recorded session so I can play from the beginning? So this webinar will be delivered every month, and I believe this was recorded as well. I'll have to double confirm, and if it is, then it's something you can access when you contact your account manager. Sure, no problem. I see a question from Hilman Pradana. When the price is ranging and a narrow channel, do you recommend to use a pending order before breakout? Okay, very good question. So pending orders is something I haven't discussed here. I think I use them all the time. I think they are a smarter way to trade. Basically, what Hilman is asking is, if you are, let's say, in a channel surfer and the price is somewhere here, and you don't want to start purchasing your lots here, but you believe the price should get to the moving average first, you would place a pending order or a tripwire in the market, so when the price hits it, your automatic long position is triggered, your lots are purchased, and automatically your take profit level and stop loss levels preset, right? So that you don't have to sit in front of the screen the whole day. So I think pending orders are smart. Your question is more about, do you recommend using the pending order for the breakout? Now the problem is, yes, you do, but the problem is you don't know in which direction the breakout is going to happen. You know that a breakout is going to occur when you get a convergence in the Bollinger Bands. That's the beauty, right? So if you look at the Bollinger Bandwidth indicator, it can actually, to some degree, predict that breakout will happen. But if you could predict in which direction, then yes, of course, you could predict the future. But unfortunately, you can't. So we would not suggest you placing pending orders unless you are trading a hedged news strategy, which we haven't gone through here, but I think this is what you are referring to when you are agnostic as to the direction of the breakout, because you set a pending order somewhere here when the price is here and another pending order here, right? And regardless of where the price goes, the profit you would make on the news-driven breakout would more than offset the loss you would on this trade. So if you are kind of alluding to a news hedging strategy, then you can use pending orders for breakouts. That's some pretty advanced stuff, though. Okay, I see a question from Muhammad Lufti Aula. Can I mix daily Bollinger Band and weekly Bollinger Band in one chart? Interesting question. Daily and weekly, you can. Again, these are some pretty large time frames, and you can use the confluence between those two bands to triangulate your position better, or to enter your position. Definitely, you can use what you're referring to is known as multi-time frame analysis, MTF. This can be used. It's smart to use it. The charts, of course, are very large, daily and weekly charts. So you're basically looking at kind of weekly or monthly positions. Just be careful to you'll need some pretty wide stop losses there, because you're subjecting yourself to news risk. But in theory, yes, it can be done. I see a question from, which risk-reward ratio is more effective, 1 to 2 or 1 to 5? Doman, great question. So the higher the risk-reward ratio, within reason. I mean, everyone wants to have a 10 to 1 risk-reward ratio, but when your position is in profit and you're 50, 60 pips up, you have to go against some pretty strong human emotions to continue and stay in the position, right? Everyone likes to capture gains quickly, and they like to let their losses run, and that's a recipe for disaster. So it's a great question. Is 1 to 2 better or 1 to 5? 1 to 5 is fantastic if you can stick to it, because again, winning trades by a ratio of 5 to 1 shows some pretty serious skill and emotion control. This is why we have suggested 2 to 1. That's more palatable. You can set your stop loss of 10 pips and your take profit of 20 pips, and that's if you can repeat that regularly, then you're going to grow your capital over time. I've only seen the very best traders kind of having 5 to 1 risk reward ratios. They're also the ones that generally have lower win rates, 30%, 40%. But the times that they win more than makes up for the times that they lose. So in essence, I would suggest somewhere 1 to 2, 3 to 1. It's more realistic. I think it's more calibrated to you as your emotions, especially if you are a new or an intermediate trader. I see a question from Alois Clement. Hello, please point to all strategy exactly chart where they open and close positions. Okay, Alois, I will try my best to do that. Just one moment, please. So there are four formations. Let's start with the channel surfer first. So basically, you see this is the price. It's surfing along the upper channel. It's coming back down to the moving average, surfing, coming back, surfing. Okay, it's creating higher highs. The entry is here. The stop loss is here. The take profit is somewhere here or here. Here on the waterfall, the entry is after 4 candles being identified. The stop loss is at the moving average. The take profit is twice the stop loss or 3 times the stop loss depending on your risk reward. So it could be here or here depending on pips. For the sorry, this slide should be titled a Bollinger breakout. For the breakout, the entry is after the close of the first candle outside the Bollinger Band, so somewhere here. The stop loss is here at the moving average. The take profit is totally up to you, typically 2 times or 3 times the stop loss, or at the nearest resistance point or pivot point. When you get a breakout, sometimes you'll get the first resistance. I'm assuming now a northern breakout. You will normally see that the resistance is broken and that turns into a support, which can also act as a good point where you set your stop loss. For the hummingbird, you would enter as soon as you locate the position. The ideal entry is at the moving average, but if you can't get that, you would enter somewhere here with a take profit level at the first Fibonacci retracement level, which is 21% retracement. You need to draw a Fibonacci retracement pattern from the pre-draw price all the way to the to the pre-rise price. You need to draw a Fibonacci retracement pattern from here to the peak, and it will then automatically create Fibonacci retracement probabilities, and you want to place your take profit at the first level. Okay, I see a question from Rumen Petrov. Do you always wait for the bar to close? No, Rumen, I personally don't, but there are traders that do. That's basically your comfort level. There is no right or wrong answer to this. Waiting for the bar to close when you are trading reversion is smart. When you are let's say I don't know if I have a good example here, but let's say you are do you see this price here? Do you see how it suddenly broke down? It wasn't driven by news, but it was driven by some large player, and the price actually resulted in a Bollinger breakout south temporarily, right? It wasn't as powerful as this one, but if I would have seen this and I wouldn't have seen any of this, so let's say I was at time 0 here, as a mean reversion trader, as someone who likes to bet against a trend, I would say, okay, you know what, this has fallen too far too fast, it's probably going to rise, I can capture a few pips, I can scalp a few pips, right? Now, the risky thing is that this could actually be the beginning of a new trend, south, in which case I need to keep my stop loss very tight. But if I'm taking a long position, in answer to your question, the smart thing to do is to wait for this hammer, this green candle, right? Because that shows me, okay, this candle is closed. That means the trend is probably over. And once this is confirmed, I would lose out by a few pips because I didn't enter here, but then I would enter my long position here and then wherever take profit, wherever I think, 10, 15 pips or whatever. But the beauty is, if you wait, if you have that patience, you can confirm the end of a trend or the start of a trend. That's the important thing. Waiting allows you to confirm that. But you don't always have to wait. For example, in a breakout, when you're trading price action, how many candles are you going to wait, right? At what point are you going to say, okay, it's time to get in? For breakout, I just take the breakout when I know, what news is driving it. Okay, I am trying to expand this window so I can see more questions. All right, any more questions from anybody? Alfie Ibrahim, very good question. So it's a loaded question. There's a lot of ways to know when it's actually the end of a trend or if it's just a corrective wave amidst a larger time frame trend. Unfortunately, I use Elliott wave analysis a little bit. Again, I said it's very overhyped, very over-engineered, but let me give you an example here. So in answer to your question, the simplest way to do this is, when the prices hit a major resistance, let's say R2 or R3 after rising the entire day, it's most likely that it's going to continue up and up and up. Everything that goes up has to come down. So you use resistance points to tell you when, okay, you're probably going to get now a proper retracement as opposed to just a micro retracement. So this here is the first wave up, the second wave, and there was a third wave. And when I'm at the third wave, there's only, statistically speaking, 2 more waves left before the trend officially becomes a larger scale retracement and a reversal, right? So you need to look at the number of waves. And normally rises in the market come in 5 waves, and the market corrects in 2 to 3 waves. So that's the way that's one way. I would triangulate that with obvious resistance points to tell me when the actual trend reversal will happen. And then the third way, and this is the more fundamental way of looking at it, is of course the what's driven the trend up. So for example, let's say now people are getting excited about the European Central Bank, the inflation data yesterday and them reaching an accord with Greece and having a subsequent impact on yields in Europe, and of course potential rate rises across Europe, which I personally think is interesting at best. But let's say that is the case and the euro rises and starts a waterfall up, right? People start to get excited. In this case, because this is driven by such a powerful event, people believing that Eurozone may be raising rates at some point, like we saw with the dollar, all the resistance points are blown out of the water. R1, R2, R3 over a period of days just gets broken out, right? So if these resistance points, by the way, are obviated by news, no one cares about resistance points and support points when there's powerful news. They are as thin as ice. So when they're blown away, at that point, the only variable you have at your hands is what is the next piece of news that's going to change the trend. So last year, and even a good portion of this year, Janet Yellen of the Federal Reserve was talking up, that they might be raising rates at some point this year, right? But it was purely data dependent. If you remember, everyone was talking about a data dependent US interest rate normalization from 0% to 2 or 4% at the end of this year. And as we see, the data in the US has not been supportive to raise rates yet, right? And so the dollar, however, rose. It rose against a basket of currency pairs over the months, and it obliterated resistance points, right? At that point, none of this technical theory would have worked. At that point, because there was a structural trend in play that was driven by very fundamental news, the only thing that could retard that trend or reverse that trend would be countervailing news. And what that is basically, bad non-farm payrolls, bad PMIs, bad consumer confidence data and all that, which would basically make people lose faith in the original news that drove the trend up. So I guess what I'm saying to you is that as long as there's no major news in play, you got to use resistance points and waves. And, to some degree, maybe oscillating indicators like relative strength index, which show overbought and oversold levels to find out when the trend may be over. But when there's news in play, you just have to wait for that big news. Martin, I see your question. This is all theory. What is a performance traded? So I don't understand that question. So this depends on the trader. There is no win rate. It depends on your own win rate with it, your own management. This is just the way to look at the market and implement it. It depends on your take profit levels, on your ability to withstand drawdown. Effendi, what is the potential breakout type for good trend? Breakout the middle band or breakout big candle touch? Okay, that's a really good question. So, yeah, that's actually a really good question. The breakout that we have discussed here is your classic breakout, where you get the breakout of the upper Bollinger Band or the lower Bollinger Band. You can also get, this in theory, when you see here, could also be considered a breakout when it broke the middle Bollinger or the moving average, and the price continued south. The more cleaner breakout, in answer to your question, is this one, the Bollinger breakout, where you have the hourglass formation, right? The bands get tight, then they start to diverge. Okay, I see a question from Bagus Pujo. For the buy entry, should we wait for the bar break on the middle of the BB? Oh yeah, okay. So you're asking about the surfer. Yes, in answer to your question, or a touch or a break, right? Or you can wait for the candle to close. That it's much better to wait for the break as opposed to take it early, right? That's not advised. Wait for the touch or the break. Okay, see a question from Martin Konitz. I have a lot of EAs with Bollinger and is profitable. That means senseless. I don't understand your question, please. If you're using EAs with Bollingers, yes, that is probably a senseless thing to do, because what I have described here cannot be programmed into an EA, or it can, but it will take an immense horsepower in backtesting. This requires a human computer to do these trajectory checks and entry points. But if your EA actually can do all of this and you're getting a low win rate, that would be interesting to see. Kindly send me the EA. Christoph, I see a question from Christoph. What pairs do you prefer? Okay, this is a good one. So if you're trading the breakout, this is actually a fantastic question from Christoph. Breakouts, normally the news that drive breakouts like these, they impact all pairs, but the pairs that I would suggest when you're trading news-driven breakouts is, of course, the majors, the Euro US dollar, the US dollar Swiss franc, the British pound US dollar, the majors, basically, right? The good thing about those also is that you're not hit by spread. So sometimes during news, these pairs, they have 5 pip, 10 pip entry spread, and that can impact your of entry and the economics of your trade. So we would suggest stick to the majors when you're trading the breakout. The waterfall and the channel surfer can be traded with all pairs. All I would ask you to do is please make sure that there's enough liquidity in the pair to drive this trend up. If you're trading price action, you need to make sure there's enough liquidity so that the market doesn't just die on you. And this happens after 6 p.m. Sometimes the market, when London closes, 40% of volumes are taken out of market. So you want to trade price action strategies like breakouts, waterfalls, channel surfers during the main day, right? And trade it on pairs where there's enough liquidity. So I would always prefer the major pairs. Now, having said that, if you are trading range-bound strategies like mean reversion, right? Let's say you are trading a flat Bollinger channel. In this presentation, we've always talked about trending Bollinger channels or diverging Bollinger channels. But let's say you're trading flat Bollinger channel, and you are taking a long position when the price hits the lower Bollinger band, or maybe a support S1, S2. The better pairs to do that on actually are the pairs that are lower liquidity, because when they bounce, they tend to bounce higher, and you can capture more pips. Assuming you have no exit spread, that can work in your favor. Okay, so it's a careful interplay, but I would suggest at first you can try this with the major pairs. If you're trying to trade around news, so if you don't want news to impact your trade, I would suggest that you trade these major pairs and make sure that that there is no major news for 1 or 2 hours after you've taken your trade, because news can destroy and trigger your stop losses very easily. Thank you, Alois. Alois, your question on the 1-minute charts. So this is something you can use to time your entry. I think there was a question earlier from I think one of the members here asked a question about entering these trades, waiting for the candle to close, or just entering them when it touches. You can zoom in to your 1-minute charts to time this entry better. That is something to do. If you have time, you can certainly use it, but I would never use a 1-minute chart to take a position, for a few hours. That's very risky, because the predictive capability of 1-minute charts is low. Okay, I see a question from Mohammed, great question. Mohammed is asking, in gold, is this BB strategy good? In our experience, no. So gold, gold and oil and certain commodities. So I've tried trading this on sugar and wheat and gold and oil. And truth be told, those are so driven by fundamentals. They are driven by, gold is bought when there's a risk-off trade, when there's bad news in the market, indices are dropping, gold rises. When there is a miss in CPI, when there's a beat in consumer price inflation data across the board, people buy gold because gold is an inflation-protected security, right? It's a hedge. It's an inflation-protected. It's a hedge against inflation. The Bollinger Bands are good for your classic currencies, for even stocks, but when you're trading commodities, there is too many variables that are macroeconomic, and in my experience, there's just too much volatility in applying this to gold. But maybe you have better luck. Good luck. I see a question from Rumen Petrov. You mentioned to trade 6 low correlated pairs. If we're able to trade the majors at first, which ones would you pick that are low correlated? Great question. So, Rumen, I trade US dollar, Swiss franc, and I trade breakouts in that. The reason I say this is by the time US dollar news is out, which is 2 p.m. GMT normally, around there, roughly speaking, right? 1 p.m., 2 p.m., depending on daylight savings time. The good news is that at that time, the Swiss market is in its final hours, and there's rarely any news coming out of Switzerland, right? Unless it's the type of news that the Swiss National Bank released earlier on this year, destroying multiple currency brokers. So, when the news comes out, it's very big. Luckily, not a lot comes out of Switzerland. So, isolate my risk, because then I'm literally isolating the news risk purely to the US dollar, and the Swiss franc literally is a dud pair then. So the US dollar Swiss franc is one that I trade. The British pound US dollar by the same logic, okay, because when the US dollar news is coming out, the British pound is in its final hours, and when London closes, very few people are trading the British pound. So that's the way to do it. US dollar, Japanese yen, again, same logic. Japan is asleep by the time US dollar news comes out. So you can isolate the pairs, because remember, when you're trading these pairs, when you're trading, let's say you're trading euro US dollar at 9 a.m. GMT, or let's say actually 2 p.m. GMT, right? When both sessions are open, Europe and US, your trade is subject to 2 risks, European news risk and US news risk. So always take that into account and stick to the ones I told you. There is, if you consider the AUD USD as a major pair, which now it's increasingly become, that's a great one to trade as well. It tends to be quite bouncy. I know that doesn't sound that technical, but it tends to be good for mean reverting strategies. So I think the best thing to do is get in touch with your account manager, and I'll send them a list of pairs that I suggest trading with these Bollinger strategies. I see a question from MD Yasmi bin Saim. Hello, sir. Can I use BB with fractals? So fractal trading, which predicts the flight path of and geometries of formations, which is pretty advanced stuff, can be used with Bollinger Bands. It is not something that is readily easily to learn, but if you understand fractals and fractal shapes and how to use those to predict flight paths or predict the trajectory of the trade, and you understand Bollingers, you can combine the two. It's a combinatorial process. That's the beauty about FX. You can combine indicators with strategies. It's not something that I have knowledge of, though. So it's something you would maybe need to access the mind of another trader for combining the two. Okay, I see a question from Kash Karmokar. Which time frame will work better to get 30 to 50 oyos? I don't know what an oyos is. Maybe you could rephrase that, please. I see a question from Takashi Nobuhiku. Does it make sense to place a stop, buy, or sell order before big events? So this is the news, the kind of, never say zero risk, but it's the hedged news strategy where you place pending orders at certain levels, both above and below the current point, current price, normally at the pivot, above and below, with the view that either one of the two would be you're going to be right either one way or the other, and that's in explosive news events. It's a strategy you can try with virtual money. It's not one that we have gone over here, but it would, of course, manifest itself in a Bollinger breakout. But Takaishi, one thing I would say, if you are not trading this hedged news strategy and you're trying to predict the news, which is why you're asking me, do you place buy or sell orders before the news, that's risky. Okay, that can be risky because predicting the news is extremely difficult. And I will tell you that you are a retail trader, I'm a retail trader, and the tools that we have at our disposal are at a slight disadvantage to obviously the tools that investment banks and hedge funds have at their disposal in terms of when they get the data, right? In terms of when they're getting the data. So something really interesting happened last month, or I think it was beginning of April. I think it was the first week of April of this year where you had a very big miss in US non-farm payrolls. And the number expected was 250 and it came out at 124. This is, again, just from memory. But it was very sad to see. You could easily see market manipulation. But before the numbers came out, almost 25 minutes before, a huge position was taken. And you just know that was most likely insider information. People said it was pre-positioning. I don't buy it. I mean, we know what happens in these markets. It's very rare that brokers would play against you. I think that's a myth. But it is possible that certain very gifted, privileged investment banks and hedge funds in this market do have access to quicker information than you do. So I would not go down the route of placing buy and sell orders with a view of trying to predict the news. Well, I see a question from Mohammed Lufti Ola. When's good in the market with BB? London market, Asia market, or US market? Again, great question. So all markets work for BB, but different formations work best in different markets. So let's start with the Asian market. There you will unless there's news out of the Bank of Japan or the Reserve Bank of Australia or New Zealand or whatever, if there's no news, you would get Japan generally is a quieter market. A lot of the EAs tend to perform well in these Asian sessions. And what we would say is that the ranging strategies, in fact, the ones that I haven't not gone over today, they work really well in the quiet markets. A lot of these strategies like the channel surfer, the hummingbird, the breakout, and the waterfall, they work better in the main sessions, okay, because these are driven by liquidity. So, for example, in the USA market, the only formation that I trade is breakout. I wait for some major impact news out of the US, medium impact to major impact, and I trade that, right? That's the best way, in my personal opinion. Again, this is not the opinion of Tickmill or anybody. My personal opinion is to trade breakouts in the US session because the US session is so news heavy. Any other questions, anybody? Sure, Mohammed. Thank you. And it's good to see that you've been using BB for 3 years. That that lays credence to the fact that it's a very powerful tool. I think BBs can be very dangerous if not understood properly. If people just go long when it touches the bottom and go short when it touches the top BB, that's a recipe for disaster. But I think, like you, I've found them to be extremely useful.